In 2021, Achego's capital management collapsed after taking large leveraged positions in a few stocks using total return swaps and synthetic exposures, including options. The positions were built without appropriate hedging or transparency, leading to massive losses when stock prices moved against them. This event highlighted the danger of excessive leverage and poor risk oversight when using derivatives. Even sophisticated tools like options can become dangerous when used without a disciplined risk framework. The lesson: options offer power and flexibility, but also demand structured, scenario-tested risk management to avoid catastrophic outcomes. Options offer high leverage, asymmetric payoffs, and exposure to multiple risk dimensions, all of which can result in substantial losses if not managed properly. Key reasons to focus on risk include avoiding large losses from directional bets, controlling exposure to volatility and time decay, protecting capital and portfolio integrity, and building confidence in repeatable strategies. Maximum loss refers to understanding worst-case scenarios for every position. Break-even point means knowing where the trade becomes profitable. Delta exposure involves tracking how much directional market risk exists. Vega sensitivity is important because high Vega positions can swing rapidly with volatility. Data decay describes how option value erodes over time, especially near expiration. Margin and liquidity require ensuring enough capital to withstand daily price swings and meet margin calls. Diversify across asset classes and expiries. Monitor Greeks at the portfolio level, not just per trade. Use scenario analysis such as what happens if volatility spikes or if markets drop 5%. Cap total exposure and avoid overconcentration in any single option type or strike. Stop loss orders help exit positions automatically at a certain level. Position sizing rules involve risking a fixed percentage of capital per trade, such as 1 to 2%. Hedging means using other options or underlying assets to neutralize unwanted risks. Rolling options allows extending or shifting positions as market views evolve. Monitoring tools include platforms with real-time Greeks, margin calculators, and volatility tracking. Options are not only for traders, they are core tools in modern portfolio management. Protective strategies involve hedging equity portfolios with puts. Yield enhancement strategies include covered calls in retirement accounts. Event-driven positioning means using spreads around earnings or central bank events. Tail risk hedging refers to buying out of the money puts as insurance against market crashes. Ultimately, success in options trading is not just about picking the right direction, it is about structuring risk so that even when you are wrong, you are still in the game.